Are you a 9 to 5er that's trying to buy your first or next rental property, but you're not really sure how to get it financed? If so, this video is for you. I'll discuss the 5 key differences between a conventional loan and an investment property loan. Hey, my name is Dustin Boudreaux, and over the last few years, I've bought over 100 rental properties, and I've done it all while having a demanding career. So if that is you, I understand, and I would like to talk through some of the ways that you can finance your rental property, especially if you're just getting started with your first one or your first couple. So quick backstory. When I bought my first ever piece of real estate, which was 2 properties, one in front of the other, I was going the conventional route. That's just what was recommended from my agent and lenders and the whole thing. And come to find out, the way this property was not a qualification of a conventional loan. So had to make a quick pivot, was introduced to a commercial bank, and that's where I first learned about commercial loans or investment property loans, and it was a game changer for me in a very good way. So throughout this video, you may hear me reference investment property loans, commercial loans, portfolio loans, debt service coverage ratio loans. All of those mean the same thing. They are designed to be for investment properties or rental properties. So just know if you hear a different term from me, that's exactly what I'm talking about. But let's dive in. Let's talk about the 5 key differences and some things to be aware of. And my goal is, by the end of this video, that you have a really good understanding of not only what the two are, but what may be the best route for you in your personal situation. Because I believe there's really not a right answer. There's just a right answer for you and what you're looking to accomplish. So let's get into the first piece. So let's talk about the purpose of a conventional loan and the purpose of an investment property loan. First and foremost, conventional loans are usually for folks that are looking to buy a home to live in, your personal residence. That's why you'll see some really great things like lower down payments, longer loan terms, which we'll talk about here in a second. And then on the other side of this, investment property loans were created for just that, to purchase and buy investment properties or real estate. And so you'll see a trend throughout these 5 differences, all beginning with the purpose. So let's get into the second thing, which is down payment requirements. When you're using a conventional loan, again, with the context of usually for your primary residence, you can get away with having much lower down payments. So take, for instance, an FHA loan where you may only have to put 3.5% down, or a conventional loan where you can put as little as 3 to 5% down. Those are all in because you're going to live in the property. Whenever you look at an investment property loan or a commercial loan, banks typically will require you to have a much higher down payment. Think of like 15, 20, 25%, because they view loaning money out for investment properties as more risky than a primary home. And let me just paint you a really clear picture of why that is. If you were faced with a decision to pay your house payment where you and your family live, or your rental property payment, which one would you choose? Most folks would say I would pay for the property that has a roof over my family's head. And that is what most people would say. And so that is why banks look at rental property investing as more risky. They want more down payment, more skin in the game. However, I will tell you, I work with a handful of banks that do not require any down payment if the deal is good enough and there's still enough equity in the property once the bank lends me the money based on what it's worth. The key there, that's a whole separate video, but the key is you need to be able to buy that for way under market value. That way you can add your forced appreciation through rehabs and what have you, and where it makes sense. But nevertheless, the 2 differences in down payment is primary residence and then investment property, which you will not be living in, which is why they usually require more. Number 3, let's talk about interest rates. Whenever you are doing a conventional loan, usually your interest rates will be lower. Again, in the context that it's something that you're going to live in, it's less risky for the bank. And also, there's a lot of loans where government or government agencies get involved in the case of an FHA loan, which I'm sure you've heard of. Maybe you've used it yourself and you're familiar with it. And so interest rates are lower. Whenever you look at commercial loans, my experience has been that the interest rate is usually about a point higher, sometimes less than a 1 point, but usually a point is a good thought process. And that is also with the context because it's riskier. Commercial loans and commercial banks may not be using government funding. They might be using in-house funds that they're lending themselves, and so they can require a premium. Another reason is they don't have all of the red tape that you have to jump through to get those lower interest rates. So sometimes they can demand their premiums and their margins on the interest rate. In my opinion, a lot of times it is worth it not to have to jump through the red tape. But again, run your numbers, figure out what the case may be on what is best for you. Number 4, let's talk about loan terms. Pretty standard. If you own your own home, there's a good chance that your loan terms are probably a fixed interest rate with a 30-year amortization, which means you have 30 years to pay it off, and that's what the payment was calculated on. Whenever you get into commercial loans or investment property loans, there is a lot of different ways this can be set up. What's pretty common is you'll see 15 to 20-year AMs whenever it comes back to repaying the loan. Again, I work with a handful of banks that do 30-year notes on rental properties, and then some that do less. So anywhere from 10 years to 30 years is what you'll see whenever you're looking to buy a rental property. A thing to keep in mind when you're looking at loan terms, the further you're able to push out your note or your terms, so aka 30 years, your payment requirement will be much less than, say, a 10-year note or a 15-year note. This will drastically make a difference on what your note payment is to the bank each month. My personal opinion is I want to be responsible of paying the least amount that I can pay or my obligation to the bank every month. And if I decide I want to pay more than that later, I can do so, but it's not a requirement. So very much keep in mind, loan terms will drastically affect what your note is every month to the bank, which will affect your cash flow and your profitability. Last but certainly not least, number 5 is rental income considerations. Whenever you look at a conventional loan, let's say in this case, an FHA loan, more times than not, you will not be able to use the income that you'll bring in from your rental property to help you qualify for that loan. A scenario where you could is if you buy a multifamily, let's say a duplex, you plan to live in one side and you'll rent the other out, you may be able to use some of that rental income to help you qualify for that loan. On the flip side, whenever you use a rental property loan or a commercial loan, they are designed to buy rental property. So the bank will allow you to use the projected income to help you not only qualify for the deal, but to help see what that debt coverage service ratio will be to repay the loan and make those payments each and every month. So that is also another huge reason I believe in commercial loans, because you can use the strength of the deal to not only help you qualify, but pay the loan down every month as well. So in recap, those are the 5 differences between a conventional loan and a commercial loan. So as we wrap up, I would say, maybe you're somebody, as I mentioned at the top of this video, 9 to 5 with an established career, and you're not really looking to do house hacking. Maybe you have some money or you have access to money where you don't want to do the house hack, the FHA, and jump through the red tape. Completely fine. The commercial loan, investment property loans are where you want to be. That's how I do all of my rental property loans, and it is awesome. You can move very fast. There's not much red tape, and you can be creative on how these things get financed. And so again, there's no right or wrong way. Just pick one, decide to go full force at it, and get your first deal or your next deal done. And I appreciate you watching this video. And before you run, consider liking this video and subscribing to the channel. I talk about how to buy a rental property as a 9 to 5-er each and every week. And so thanks for tuning in. This video is a wrap. I'll catch you on the next one. Bye for now.